Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, I'm gonna talk about what I think about the next stock market crash and the stock market in general, okay? Because during those days, during those red days here, everyone is going crazy. I see some folks that they are selling stocks, what to do now, what to do now. So I'm gonna try to say and explain you what am I doing and what I think about the stock market right now and what to do right now, okay? So leave me a like if you find this video interesting and subscribe to the channel and let's begin. All right, so this is the S&P 500, the future, okay? Because right now the market is still closed, and it looks like that we started the week with another red candle that right now went down even more, and right now it is pushing up again, okay? So everyone is asking, was the end of this rally? So are we now ready to do something like that? Okay, so to break those levels here and go even lower. So, okay, so should I sell everything right now? Should I get profits right now and run before it's too late? Okay, so that's what everyone is asking. Okay, and it's normal to ask those questions. Anyway, I'm gonna tell you what I think. Okay, in my opinion, to have something like that, we will need only one thing that is gonna happen, and that thing is another second wave of the pandemic virus. Okay, a huge wave. Why is that? Because another wave is the only thing that can really change the fundamentals right now. Okay, because that one was the result of the first wave of the virus. Okay, lockdown, the economy is shut down, and we know that. Okay, everyone knows that earnings are going to be bad for a certain amount of period. So what the market do, the market goes down, and it's like I'm understanding that the economy is stopped. Okay, it's like a pause in the economy. Boom, down and go up again. Here we are actually starting to see the end of the tunnel of the pandemic. Okay, so the market is telling us, well, okay, now we had this problem, but it's gonna be solved. Okay, so even earnings and all those kind of things that they have been bad, they are gonna be bad for this year, but you know what, we are gonna come back. Okay, so that's what the market is doing in terms of fundamentals. The market is not looking at today, it's looking at the future. Okay, now what we need to push it back, well, another wave of pandemic, and you can understand why, because it will be the same thing as here. Okay, because when another wave of pandemic comes back again, uncertainties come back again, and we don't know how earnings are gonna be. Okay, we already are in a bad situation. Imagine what is gonna happen if another wave of this virus happens. Okay, it's gonna be even worse. So in my opinion, that is the only way to push the market even lower to those previous lows. Okay, but let's say if this incredible scenario does not happen, what to do? Because in my opinion, if the virus doesn't come back strong as before, those lows are gonna hold. Okay, doesn't mean that the market is gonna skyrocket up forever, but meaning that we could go sideways, we could retrace and pull back, but not go below those things. Okay, and this is probably one of the scenarios that in my opinion are likely to happen. Okay, why? Well, first of all, we can go here and see that basically the interest yield in US, but all around the world, because Europe is the same. Okay, has been growing until a certain point, and after that it's been decreasing and constantly. Okay, and right now we are at the interest yield which is below 1. Okay, it's between 1 and 0. Okay, And that means two things. The first thing is a simple one. When you have this, meaning that normal monetary policies are out of ammunitions, okay? So what that means, when you comes in that point, meaning that central banks, they have to adopt extreme policies. And those extreme policies are becoming normal policies because you cannot do normal policies anymore. And that's why we were not talking about helicopter money in 2000. Why? Because the interest yield was already high. So you had the power to push it down and to actually save the market. But right now, to save the market, you cannot push the interest yield even lower, okay? You are at the limit. That's why they are starting to print more money. Stimulus checks, things like that, helicopter money, they are doing it all around the world, okay? Not just in US. Why is that? Because that is the only way to do what they have to do, okay? If something bad happens. And so that means another thing. To do that, what those incredible policies are is basically printing more money. And what happens when you print more money? Well, the value of money decrease. Okay, that's it. Not in an incredible way, but it's a slow process. Okay, but this slow process actually exists. Okay, now that means another thing. Inflation. Okay, inflation that I'm not telling you that it's gonna be huge, but I'm telling you that inflation is going to exist. Okay, around 2-3% and things like that, and we all know that. Okay, a healthy inflation for the economy around 2.5%, probably with this balance sheet. Okay, of the Fed balance sheet. This is the Fed balance sheet. Well, it's normal to happen. Okay, an inflation like that. So, if we put this thing together, we have to remember that interest yield is very low, and inflation can be without any problem around 2 and 2.5%. Okay, so basically, what it means, it meaning that if you invest in U.S. Treasury bonds, you are gonna actually lose money. Okay, why? Because you are getting at 0.7, 0.60%, and basically you have to discount the inflation. Okay, you have to discount around 2.29 and things like that. That's what actually happens in normal inflation. Okay, so the result, the net result, you have a real interest rate which is negative. Okay, it's a negative rate. So what that means? Meaning that a lot of people would not invest in bonds, okay? Of course, you have institutions and things like that they do hedging things, and so bonds, they are going to invest in bonds as well. But normally, okay, would you invest in something that makes you lose money? No. So there is going to be a shift, and this shift is going to be even bigger. Okay, longer this thing lasts, but people are going to invest where? Guess where? In the stock market. Okay, so overall, over the long term, of course the stock market is more appealing to those things. Okay, well, because you don't want to sit in too much cash, because your cash is losing value. Inflation is going up like always, okay, but not up incredibly, but up at a higher, at a normal rate, okay, around 2 and 2.5. But if you have interest yields at zero, below 1, 0.6, well, guess what? Sitting on cash, you are just losing the purchasing power. Okay, you are just losing the value. Your money is losing value. Okay, so that's why the stock market is very appealing. And you have to consider another thing which is interesting in my opinion, and this is the middle class. Okay, the middle class is going to increase. In 2009 we had 27% of the total population were into the middle class. Okay, and that has almost doubled in 2019, 47%. And that is expected to grow around 61% of the total population in those countries for 2030. Okay, now what that means, of course, back then in the 1920, investing in the stock market was something for just rich people, so very wealthy rich people and things like that. Now look at how the world has changed. Right now everyone can invest in the stock market because of apps, things like that, technology development, and so on. And this is gonna be even more, okay, in the future. And when the middle class actually increase, well, guess what? More people are gonna invest in the stock market. More people are gonna be interested in investing, okay. And if the wealth increase, people, they're gonna have money to invest, okay, and not just to survive. And this means even another thing, the consumption, okay. The consumption is gonna continue to increase. Why? Because if the middle class increases, well, people are gonna overall spend always more, okay. And remember that also the global population increases, okay. And I don't know you, but for example, if we think about our grandparents, they didn't know how to use technology, they didn't know how to, most of them, invest in the market and things like that, while you do, okay. So your son, your children, they are gonna know even better, okay, especially if this trend of the middle class continue to increase, okay. So overall, over the long term, I believe that investing in the stock market can be appealing today, okay. So should you sell everything right now? Well, in my opinion, no, okay. Now of course, if you think that you have some stocks that are way overvalued and you want to take some profit, well, just do it, okay. It's fine to do that. But overall, over the long run, I think that investing in great businesses, undervalued businesses, or great businesses at a fair price is still a nice, smart move. Okay, you don't want to sit too much on cash, in my opinion. Another thing, is the market hugely overvalued? Well, in my opinion, not too much. Okay, not too much. I did a lot of evaluations of single stocks, and we can see that a lot of them are actually near the fair price, okay? Or even if some of them, it looks a little bit overvalued, but it's not too much overvalued, okay? There is not something that was like 4 times its real value, okay? So like a bubble and things like that. We are just around the fair price. A lot of value stocks, a lot of industrial stocks are actually still undervalued. Okay, I did the valuation of Boeing. Now the tech industry looks like a little bit overvalued, but not too much. Okay, and that's normal to have the Nasdaq, which is a little bit overvalued, but it's not too much like we did on Facebook. Okay, Facebook is around $215 the fair price, so yeah, it's overvalued by just a little bit, okay. That makes sense, that's normal, that's how it is. So actually what you have to do, well, in my opinion, you have to continue to do your researches and to search for good companies, good businesses to invest in for the long term, okay. Because I see a lot of people, they're asking me, oh, what do you think is gonna happen the next week? Guys, I don't know, okay. I don't know, no one knows. What I know is that overall, over the long run, investing in good businesses and in the stock market with the fundamentals that I showed you before, just showed you, well, is gonna pay, okay. And that's it. But my view is at least 7-10 years, okay, not tomorrow, not the next week. If another pullback is gonna happen, well, guess what, more opportunities, okay. Now before the end of this video, I want to thank you everybody for this, okay. I just hit 1,000 subscribers. So to thank all of you, I decided to share a free download link of one of my templates, okay? And this template is actually this one. Now, in this template, you have basically here You have the balance sheet part where you can go on Yahoo Finance financial section, okay? And you can take whatever you want. So for example, here you put the revenue, here you put the cost of revenues, and everything is going to be calculated for you, okay? You have the cost of revenue margins, gross margins, net margins, operating margins, all those things. Like for example, we put 10 as revenue and 5 as cost of revenues, so that we are gonna have 5 as a gross profit and gross margin 50%. Let's say with 4 as operating income, the operating margin is gonna be 40%, and let's say we put 2 as net income, and the net margin is gonna be calculated as well for us, okay? The same goes here. Let's say current assets 4, current liabilities 3, and that's what we have, okay? Current ratio, and the same here, okay? And down here, I put one of the discounted free cash flow valuation, okay? So just to make you play with it and try to understand the model. This is the formula of the model, and this is the formula of the terminal value, okay? Where you see G is actually the perpetual growth, and when you see R WACC is the rate of return you're gonna consider, okay? Now, usually as standard, you can put 8.5%, or if you want to be more fancy and precise, you can calculate the WACC directly with the CAPM model, okay? So check on Google, CAPM. Anyway, around 80%, to do some standard valuations, it's okay, all right, to do things more easier. And what we have here now, if you want to use free cash flows to equity, okay, so the free cash flows to equity are basically operating cash flows minus capital expenditures, okay? So if you use those, you don't need to deduct for the net debt, okay? While if you use the normal free cash flow of the enterprise, you're gonna end up with the enterprise value. So here you need to go on Yahoo Finance, balance sheet, quarterly balance sheet data, and you're gonna look for the net debt. Then you're gonna write the net debt here, and so that you're gonna have the adjusted fair price, okay? Now this is actually working as well. Let's try it. Like example 2.1, here 2.2. Let's say those are free cash flow to, I don't know, the equity, okay? So 4, 2.5, and we are gonna put here rate of return 8%, we said, and this perpetual growth 2.9, like the United States of America, okay? The total amount of shares outstanding, let's say there are 300 million. What does it mean? Meaning that stock X with this rate of return, with this perpetual growth, and those free cash flows is gonna have a today's company valuation of 45 billion and a fair price of $150.52 per share, okay? Now let's say we had, I don't know, 8 billion as net debt, and the adjusted fair price is 123.85, okay? Remember one thing, all the numbers are in billions, okay? So $billion. If you need to write million, you just write 0, comma, and the number later, okay? Perfect. Now, I hope you find this video interesting, and thank you again for 1,000 subscribers. Leave me a comment below and tell me if you like this template or what you think about the stock market crash. Have a wonderful day, guys, and see you in another video.